The morning most people started shouting about oil, I was not thinking about oil. I was thinking about fear. I was thinking about the old Wall Street habit of dressing fear up as certainty, then selling that certainty to anyone who feels late, underprepared, or exposed. And I was thinking about how much money gets lost every time ordinary investors confuse a loud headline with the real center of gravity. That is the mistake I have watched for decades. A war begins, a ceasefire wobbles, a commodity spikes, a news anchor widens his eyes, and suddenly the public starts moving, as if the first thing that rose must be the only thing worth owning. That is usually how people buy the top. The memo that crossed my desk did not read like television. It read like positioning. It read like leverage. It read like trapped pessimism. It read like one market trying to price two completely different futures at the same time. That is always where things get interesting. The public likes a clean story. Wall Street almost never gets one. What it gets instead is a branching road. In one branch, the ceasefire holds long enough for money to remember what it abandoned in panic. The ceasefire fails, supply fears intensify, oil climbs again, the dollar firms, and capital races toward the few places it believes can survive the next hit. Most people hate that kind of uncertainty. I have built a good portion of my life on it because when the crowd wants one answer, but the market is quietly preparing for two, price starts to separate from value. That is the gap I care about. I do not get paid for guessing what makes the best headline. I get paid for understanding where the money has already gone, where it is refusing to go, and what must happen if the pressure reverses. That is what this entire episode is really about. Not oil by itself, not even the Middle East by itself. It is about the machinery of modern markets. It is about how much borrowed money has been taken off the table. It is about what institutions hated last week and may need to buy back this week. It is about the uncomfortable truth that some of the largest moves in markets begin, not because the future suddenly becomes wonderful, but because positioning had become too dark for reality to remain merely tolerable. That distinction matters. A lot of people think rallies begin with confidence. Many of them begin with less fear than expected. That is a very different thing. The first line that caught my eye in the memo was not even a stock name. It was the target, a higher SP from here. A fairly aggressive one. Most people hear that and think prediction. I hear pressure. Anytime a major institution starts talking about a significant upside target immediately after a violent period of fear, I do not ask whether the number is perfect. I ask what would have to happen inside portfolios for that number to become possible. And the answer was simple. Money would have to rotate back into the places that had been sold hardest technology. Large growth, artificial intelligence names. The companies people love in good times and distrust all at once when uncertainty arrives. That, to me, was the real heartbeat of the whole thing. Not because technology is magic, not because every fashionable theme deserves a premium, but because the market had done what it always does under stress. It had not merely repriced risk, it had overshot into dislike. That is where opportunity begins. The easiest mistake in a fearful market is to think price decline proves weakness. Sometimes it proves overcrowding on the way out. When too many people decide to leave the same room at once, they do not stop to ask whether the furniture was still good. They just run for the door. That is what often happens to great businesses when fear comes from outside the business itself. The company did not suddenly forget how to earn money. The product did not suddenly stop mattering. The balance sheet did not suddenly become fragile. But the stock falls anyway, because a frightened owner will sell a wonderful asset to solve an emotional problem. I have seen that movie more times than I can count. The memo argued that technology could rally for two reasons. The first was earnings. The second was positioning. That combination is far more powerful than most people appreciate. If a sector has already been beaten down and then proceeds to report numbers that are not disastrous, the move can be violent. Not because the world became perfect, because the market had prepared itself for uglier news expectations or the hidden balance sheet behind every stock price. A mediocre reality can look magnificent when people were braced for a collapse. Now add the second piece. Positioning institutions had become deeply bearish, not politely cautious. not mildly skeptical. Bearish enough that a simple improvement in tone could force them into catch-up buying. That is one of the most reliable forms of market fuel there is. You can dislike the story, you can mock the valuation, you can complain that the world feels unstable, but if you are underinvested and the tape begins to run away from you, philosophy starts losing to career risk. Portfolio managers do not get fired for being temporarily bullish with everyone else. They get fired for missing large moves that their benchmarks capture without them. That is why catch-up buying matters. It is not just emotion, it is institutional survival. And then there was leverage, boring to most people, critical to me. I have lived long enough to know that markets are not moved only by opinion. They are moved by balance sheets. A hedge fund can be clever, wrong, highly leveraged, and dangerous all at once. When that leverage comes down hard during a period of stress, it creates dry powder, not moral virtue, not wisdom. Dry powder. If funds have cut their exposure, reduced their borrowed risk, and stepped back while the market turns less catastrophic than feared, then they do not merely have permission to buy. They have room to buy. That room becomes acceleration. People talk about markets as if they are giant voting machines full of abstract sentiment. Sometimes they are, but many times they are plumbing, borrowed capital withdrawn, exposure reduced, cash waiting, risk budgets reset. Then a headline changes, a ceasefire lasts longer than expected, earnings arrive better than feared, and all that sideline capacity begins trying to get back in through the same small doorway. That is how a move that looks surprising on television looks inevitable inside a trading book. Then I looked at retail sentiment. That always interests me for a different reason. Professional investors can be overpositioned. Retail investors can be overpunished. The public often sells near the point where pain becomes emotionally exhausting rather than economically rational. They do not sell because they ran fresh discounted cash flow models. They sell because they are tired. Tired of bad headlines, tired of opening accounts and seeing less, tired of wondering whether the smart money knows something worse, tired of feeling stupid for staying in. That kind of exhaustion has a rhythm to it. It is often strongest near the late stages of a washout. And if retail has been selling heavily into weakness, then one of two things happens next. Either the market gives them the disaster they fear, or it denies them the relief of re-entering cheaply. I have seen both. When the second one happens, it leaves a deep scar, because then the same people who sold from fear must decide whether to chase a recovery they no longer emotionally trust. That decision can fuel a market all by itself. The memo pointed to historical instances when positioning had become this bearish, and the following 3 months delivered surprisingly strong returns. I do not worship historical averages. They are not promises. They are not prophecy. But they are useful because they remind you how often the crowd confuses maximum discomfort with maximum danger. Those two things do not always arrive together. Sometimes the moment of greatest discomfort is simply the moment when the market has already priced too much despair. That is when I start paying close attention. Then came the bullish map, and this is where most people make another mistake. They think a bullish map means everything goes up equally. That is almost never how money moves. Money is selective. It has a sequence. It chooses a path. When fear begins to retreat, the first gains do not necessarily show up in the safest corner. They often show up where pessimism had been strongest and liquidity can reprice fastest. Small caps, the NASDAQ, broader large cap equity. Then the more cyclical names, retailers, discretionary businesses, home-related exposure, financials. Not because the economy has become flawless overnight, because these areas are tightly connected to relief. Lower oil, a softer dollar, less panic, more confidence about rates, more willingness to spend, more belief that next quarter may look better than the last rumor suggested. That is how a rally broadens. It does not begin with a choir, it begins with a rotation. One pocket gets bought, then another, then another. It is like watching water find cracks in dry soil. At first the surface barely changes, then suddenly the whole field darkens. The precious metals angle was another interesting wrinkle. A lot of people talk about gold only in the language of collapse. That is lazy. Gold can respond to panic. It can also respond to a weakening dollar. Silver can respond to monetary stress and industrial optimism in the same cycle. Miners add another layer because they are not the metal itself. They are businesses with operating leverage tied to the price of what they pull from the ground. If the market begins pricing a softer dollar and renewed appetite for hard assets, those names can move far more aggressively than the metals themselves. Again, not magic operating leverage. That is a concept more people ought to learn before they start flinging money at themes they barely understand. Then there were the financials. That one made me smile a little. Banks are easy to hate. Sometimes they deserve it. But a hated bank sector in front of decent earnings can become a tradable gift if the macro winds calm down. Why? Because banks are not only institutions, they are expectations wrapped around credit, rates, funding, and economic tone. If the market has punished them for a grim scenario, and that scenario eases even modestly, the bounce can be sharp. I do not need to love banks morally to see when they have been priced as though the world is ending. You do not make money by investing only in things that make you feel pure. You make money by understanding mispricing. That is the adult version of the game. Now, let me say something important. None of that bullish map means peace is secure. That would be childish. Markets are not churches. They do not run on faith. They run on probability. And the second script matters just as much as the first. If the ceasefire breaks badly, if attacks widen, if regional production comes into real question, if shipping lanes become more impaired, if oil starts climbing toward levels that force central banks and consumers into a new corner, then the map changes, not slightly, completely. The dollar strengthens, risk assets roll over, growth gets hit again. Airlines suffer. Anything exposed to consumer weakness and fuel pressure starts feeling heavier. And in that world, capital does what it always does. It narrows. It runs toward energy, toward oil services, toward pipelines, storage, defense, fertilizers, anything tied to hard necessity or government urgency. That is the part many people miss. They think uncertainty means do nothing. It usually means think in branches. This if, then that. If the fire spreads, own what benefits from heat. If the fire fades, own what fear already discounted. That is not trading genius. That is disciplined thinking. The market pays heavily for disciplined thinking because so few people practice it when adrenaline enters the room. What fascinates me most in moments like this is not the immediate call. It is the structure underneath the call. There is always a temptation to ask, what do I buy tomorrow morning? That is the wrong first question. The first question is, where is money hiding? Now, the second, what event would force it to move? The third is, which assets have been punished or promoted too far relative to that event? If you ask those three questions consistently, the market starts looking much less random. It starts looking like migration. Capital leaves one habitat, seeks another, then leaves that one too. Most people only see the final destination and call it obvious. I want to see the route. That is where the advantage lives. The source of the current opportunity is not that one big bank has an opinion. The source is that too many players have leaned hard into fear while the future remains bifurcated. If the world merely avoids the darkest path, that alone can power a move. That is what ordinary investors do not fully understand. You do not need paradise for a stock to go up. You need reality to come in better than the fear embedded in the price. That is why some of the best investments of my life looked emotionally uncomfortable at the moment of purchase. They did not come wrapped in applause. They came wrapped in doubt. When I was younger, I spent more time trying to be right immediately. As I got older, I learned that being approximately right with a wide margin is far more profitable than being emotionally eager with no margin at all. A market like this punishes eagerness. It rewards patience and preparation. If you are chasing what already spiked because the news frightened you, you are probably financing somebody else's exit. If you are calmly building a list of quality businesses, quality sectors, and quality vehicles, under both scenarios, you are preparing to do what most people cannot do under pressure. Act without panic. That does not mean act blindly. It means think ahead of the emotion. People hear me say that and assume I am dismissing risk. I am not. I respect risk so much that I refuse to simplify it. There is risk in buying too early. There is risk in not buying at all. There is risk in following the crowd into the obvious trade. There is risk in freezing while value improves. There is risk in over-concentrating in your favorite story. There is risk in mistaking a macro scare for a permanent impairment. The job is not to eliminate risk. The job is to decide which risk pays. That is a very different discipline. The market keeps humbling people who want certainty before they commit. By the time certainty arrives, price is usually moved. When everyone agrees on the direction, the bargain has often disappeared. That is why I care so much about moments when quality gets sold, because the world feels ugly. The ugliness rarely lasts as long as the discount. And even when the ugliness lasts longer than expected, the investor who has already thought through both scripts can keep his balance. Balance is worth a fortune when other people are slipping. Let me make this practical. If the calmer path holds, I want exposure where pessimism was deep, where earnings power still exists, where institutions may need to chase, and where valuation is no longer demanding perfection. That means selected growth, selected technology, selected cyclical recovery areas, selected financials, potentially selected miners, if the dollar weakens and hard assets catch a bid. If the darker path starts taking control, I want to know in advance where I would hide energy infrastructure, defense, the businesses tethered to necessity rather than hope. And in both cases, I want liquidity. I want room. I want the ability to move without being forced. That last part matters more than any ticker symbol. Forced people make terrible investment decisions. A man with too much debt, too much leverage, too much ego, or too little cash is not investing. He is negotiating with circumstance. That is not a place I ever wanted to live. The current market is really a story about leverage in many forms. Hedge fund leverage, psychological leverage, headline leverage, career leverage. People are stretched not only financially but emotionally, and that means reversals can be far larger than the underlying news would seem to justify. The crowd underestimates that every time it thinks price moves, because facts change. Many of the biggest ones happen because pressure changes. That is why I always come back to the same simple idea. Do not ask what is exciting. Ask what is underowned. Do not ask what sounds safest. Ask what is already priced in too much fear. Do not ask what everybody is suddenly recommending. Ask who needs to buy if the panic softens. That is where the asymmetry lives. I have also learned that in market moments like this, moral theater becomes expensive. People want to sound wise. They want to say they saw the geopolitical complexity, the commodity risk, the institutional, the retail trap, the central bank angle, the currency angle. Very few want to do the harder thing, which is convert that complexity into a map of action. That is what an investor must do. A good investor is not a collector of impressive worries. He is an allocator of capital under uncertainty. That is the whole profession. And if you cannot allocate when uncertainty rises, then you are not really an allocator. You are just a fair weather commentator on your own portfolio. I do not say that to be cruel. I say it because money has a way of exposing whether your principles were operating principles or decorative ones. A market that swings hard is a test, not of your intelligence, first of your structure. Have you already decided what quality looks like? Have you already decided what valuation looks like? Have you already decided how much cash you need to sleep well? Have you already decided what would make you add, what would make you wait, and what would make you stop? If you have not decided those things before the headlines hit, you will end up. That is a very expensive habit. What bothered me most about the memo was not the content. It was how predictable the content was for institutions and how unavailable that way of thinking remains for the ordinary person. Big money is always asking, what happens if relief comes? What happens if it fails? What gets bought in each case? What gets sold in each case? What is underpositioned? What is overowned? What happens to the dollar, to rates, to cyclicals, to growth, to defensives? That is how adults around capital think. The public, by contrast, is trained to think in drama. Who is evil? Who is winning? Who sounded confident? which chart looks scary, which stock already moved. One way of thinking creates a framework. The other creates a reaction. Frameworks compound. Reactions do not. If you want to build real wealth, you must train yourself out of reaction. That is harder than memorizing ratios. It requires temperament. It requires the willingness to look stupid for a while. It requires enough humility to admit the future can branch and enough confidence to plan for both branches anyway. That is not glamorous. It is just incredibly useful. I have never believed that wealth belongs to the person with the fastest opinion. It belongs to the person with the strongest process. A process can survive a bad week. An opinion often cannot survive a bad afternoon. And in a market like this, survival of process is what allows you to exploit the overreactions of others. That is why, when fear surges, I do not ask how to escape the market. I ask where the market is offering me a better contract than it offered last month. Maybe the answer is a great business marked down because macro anxiety hit a crowded trade. Maybe it is a minor business that benefits if the dollar weakens and metals gain sponsorship. Maybe it is an energy infrastructure name protected by a darker path. Maybe it is simply the broad market because pessimism had become too intense relative to actual earnings power. But there is always a contract. There is always some price, somewhere, that reflects more emotion than economics. That is what I hunt. And let me be honest about something else. You do not need to catch the first dollar of the move. People lose a lot trying to be heroic. You can wait for confirmation. You can scale in. You can keep dry powder. You can demand a margin of safety. You can let a little momentum prove itself. You can do all of that and still do extremely well. The market offers plenty of money to the disciplined. It reserves the worst pain for the impulsive. So when I look at this moment, I do not see one clean answer. I see a test. On one side is the old retail instinct. Chase what spiked, dump what scared you. Trust the most recent move. Assume the noisiest story is the deepest one. On the other side is the harder investor instinct. Map both futures. Know what wins if calm returns. Know what survives if conflict widens. Understand positioning, understand leverage, understand that capital rotates, understand that markets punish consensus at the margin, not in the middle of the story everyone already knows. That is the difference between reacting to markets and participating in them. I have spent enough of my life around money to know that the crowd nearly always wants the comfort of a single script. But wealth rarely comes from single scripts. It comes from seeing the second order move before the first order panic finishes shouting. The first order move is obvious. Oil jumps, defense jumps, television panics. The second order move is where serious money gets made. What happens if the fear relaxes? Who must buy back what they threw away? What sectors were hated too much? What quality was discounted as if the world were permanently broken? That is where I would rather live. Not in the scream. In the re-rating that follows the scream. And so the real question before you is not whether the world feels uncertain. Of course it does. The real question is whether you will behave like a spectator or like an owner. A spectator consumes headlines. An owner studies flows. A spectator wants certainty before acting. An owner wants a price that pays him for uncertainty. A spectator asks whether the market looks scary. An owner asks whether the current price already overcompensates him for the fear on the screen. That is the final test. When fear floods the room, do you run toward what already looks strong, or do you quietly pick through what panic has made cheap, knowing that money never stops moving? Only changing addresses. That choice will tell you more about your financial future than any market memo ever will.